What's up, everybody? Most of the housing market news out there talks about low inventory, high home prices, and the affordability crisis in our current housing market. And this is true in most parts of our country, but not all. There is a trend of massive home price reductions in certain parts of our country due to a dramatic 50% increase in housing supply that may be foreshadowing the future of our housing market. So today, we're going to go through those housing markets where sellers are forced to slash their asking prices and see how they compare to the rest of the country to see if a huge correction is imminent. There is a lot going on in our current housing market between the NAR settlements, inflation, and the uncertainty of multiple wars and how that may affect our economy, as well as an upcoming presidential election this year. So I think it's really important to see how certain parts of our country are already experiencing a very different housing market than what is being generally reported. So today, we'll take a look at an article by R.T. Swaminathan for MarketWatch titled "Housing Supply Surges by Up to 50% in These Metro Areas, and Many Sellers Are Being Forced to Slash Their Asking Prices," as well as Redfin's latest housing market update to see if we can figure out the future of our housing market. So let's dive right in. According to a new report by Redfin, home listings surged in 85 major metropolitan areas in the United States with a population of at least 750,000. These homes are sitting on the market, and sellers are forced to reduce their asking prices in order to get them sold. Most of these markets are located in Florida and Texas, where a lot of new construction is being built. But that's not the only reason home prices are going down. It's true that supply has increased drastically in the Sun Belt due to the ramp up in new construction. Daryl Fairweather, chief economist at Redfin, told MarketWatch. Lily Katz, a journalist for Redfin, writes that Florida and Texas have been building more homes than anywhere else in the country, partly to accommodate the flood of newcomers that showed up during the pandemic home buying boom. But the boom is over, in part because many people were priced out. Now, homes are sitting on the market, and home price growth is stagnating. But Florida has another problem that's causing homes to stay on the market longer and their home prices to go down, and that's the home insurance crisis that's happening there, as well as high HOA fees and high maintenance costs. 70% of Florida homeowners have said the area they live in has been affected by rising home insurance costs or changes in coverage, a recent Redfin survey found. A lot of them have seen their premiums skyrocket, and some have even lost coverage altogether because intensifying natural disaster risks has prompted many insurers to stop doing business in Florida and California. In Florida alone, since 2017, 11 insurers liquidated amid growing flood and storm risk. 5 of those companies liquidated in 2022, and United Property and Casualty Insurance Company liquidated in 2023. Increasing insurance costs and natural disasters are causing a lot of people to relocate, contributing to the uptick in resale inventory. In Florida, 11.9% of the people who plan to move in the next year cited rising insurance costs as the reason, roughly twice the national share of 6.2%. Homeowners living in areas where insurance premiums are surging are at risk of seeing their properties gain less value than homeowners in areas with stable premiums. And in some cases, they may even lose money, said Redfin chief economist Daryl Fairweather. Homes with low disaster risk and low insurance costs will likely become increasingly popular and thus more valuable as the dangers of climate change intensify. The number of homes for sale in certain metro markets in Florida in March rose 50% from a year ago, indicating that housing supply is surging, the brokerage said, offering good news for home buyers straining to afford higher mortgage rates and prices. Housing supply has increased the most in the following 5 metro areas on a year-over-year basis, according to Redfin. Cape Coral, Florida, up 51%. Northport, Sarasota, Florida, up 48%. Fort Lauderdale, Florida, up 30%. Tampa, Florida, up 29%. And McAllen, Texas, up 25%. This increase in supply is also pushing more homeowners to slash their asking prices. The metros with the highest share of listings with price reductions are the following: Northport, Sarasota, Florida, 48%. 40%. Tampa, Florida, 44%. Indianapolis, Indiana, 43%. Cape Coral, Florida, 41%. And Denver, Colorado, 37%. These are huge numbers of price reductions, which tells me that these homeowners really wanted to get out of town, even if they have to give up their super low mortgage interest rate, which has been the main cause of our inventory problem. The mortgage rate lock-in effect becomes a smaller part of the decision-making process to keep owning or to sell, Fairweather told MarketWatch. MarketWatch reports that Florida homeowners pay the most for home insurance in the United States, with an average annual rate of $11,759 projected for 2024, significantly higher than a projected national average of $2,522. So will the housing market crash in these areas? And how does that reflect to the rest of our country? Florida has the most price drops, so it seems like the market is correcting, Fairweather said, but demand is not drying up completely. Florida's housing market dynamic is very different than what we're seeing at a national level. According to Redfin's latest housing market update, the median U.S. sale price is up 5.2% from a year ago nationally, even with mortgage rates hitting their highest level since November of 2023. The median asking price for the 4 weeks ending April 21st is up 6.2% nationally, an all-time high and the biggest increase since September of 2022. Metros with the biggest year-over-year median sale price increase are Anaheim, California, up 25%, New Brunswick, New Jersey, up 14.9%, Detroit, up 14%, West Palm Beach, Florida, up 13.4%, and San Jose, California, up 13%. The metro with the biggest median sale price decrease year over year is Austin, Texas, down 0.9%. Prices are soaring despite there being more inventory than last year. New listings are up 10.2% year over year, though this number may start to go down as higher interest rates are staying around for longer than expected, therefore solidifying the lock-in effect. Active listings are also up 10.1%. The metros with the biggest year-over-year increase in new listings are San Jose, California, up 43.1%, Jacksonville, Florida, up 29.1%, Phoenix, up 25.8%, Sacramento, California, up 24%, and Miami, up 21.9%. The metros with the biggest year-over-year decrease in new listings are Newark, New Jersey, down 9.1%, Cleveland, Ohio, down 5.9%, Chicago, down 4.7%, Milwaukee, down 4.7%, and Providence, Rhode Island, down 4.4%. The median monthly mortgage payment is up 12.6% year over year, according to Redfin, which is an all-time high. Pending sales are down 3.8%, the biggest decline in 6 weeks. Pending sales are down the most in Nassau County, New York, down 13.9%, Phoenix down 13%, and Fort Lauderdale, Florida, down 12.5%. 43.3% of the homes sold in the first 2 weeks, down from 46% from a year ago. The median days on the market is 35 days, basically unchanged. 29.8% of the homes sold above the list price, also unchanged from a year ago. And 6% of the homes did have a price drop, up 1.7 points from a year ago. Clearly, Florida and Texas are probably skewing this particular metric, since their percentage of price drops are in the 40 to 50% range in certain parts of those states. Where I am in the DC area, we're experiencing a mixed market. Some homes are sitting on the market week after week getting price reductions, while other homes, sometimes in the same neighborhood, are getting multiple offers and escalating way above the asking price. Redfin economic research lead Chen Zhao recently said, "My advice to sellers is to price your home fairly. Even though sellers are getting top dollar at the moment, they should price competitively to attract buyers from the start and avoid having to drop their price as stubbornly high mortgage rates eat into buying budgets." She then went on to say, "My advice for serious buyers who can't afford today's costs is to shop for your dream home and accept that this year is probably not the time to find a dream deal. Price growth may cool slightly in the coming months if mortgage rates stay high, or rates might fall slightly, but overall housing costs are likely to remain elevated for the foreseeable future." I have to say, I agree with her. Buyers today will not respond on to greedy sellers. I've said this before, and it's true. They need to see the value, and if they do, they will compete, therefore escalating the price. It's actually really interesting to see how this narrative plays out. Everybody wants what everybody wants. Once a buyer is in competition, all logic goes out the window. Depending on the buyer's desires and personality, we have different strategies for buying in today's market. But it's not for people who think they're going to move in a couple of years. Prices are so high around here, and like I said at the beginning of the video, there are just too many uncertainties that may affect our economy and the housing markets. If you missed our video where Jamie Dimon, the CEO of JP Morgan Chase, recently warned that several headwinds, including persistent inflation, Federal Reserve policy, and ongoing multiple wars could pose major threats to the US economy, definitely check that one out next. Thanks for watching. I do appreciate it. Bye!